Hi, everybody, and welcome back to video number 8 in chapter 21. And when we left off, we were looking at correcting errors in the case of a company that did not set up an allowance for estimated uncollectible receivables. They decided to set up such an allowance for the estimated probable losses as of December 31, 2026 for the 2025 accounts of $700 here and $1,500 here. They corrected the charge against each year so that it shows the losses actual and estimated. The company has written off accounts to bad debts expense, that's to selling expense, as follows for 2025 and 2026. Okay. Number 4, prepaid insurance not recorded at the end of 2025 was $600, and at the end of 2026, $400. All insurance is charged to administrative expenses. Number 5, all an account payable of $6,000 should have been a note payable. Number 6, during 2025, the company sold an asset for $7,000 that cost $10,000 but had a book value of $4,000. At the time of sale, cash was debited and miscellaneous income was credited for $7,000. And lastly, number 7, as a result of the last transaction, the company overstated depreciation expense in 2025 by $800 and in 2026 by $1,200. Okay, very difficult to see this worksheet, but it analyzes all those errors. And here we show those adjustments for number 1, number 2. See, number 2 is here and here. And number 3 is here and here. And for number 3, they're showing the computation of that as well here under Bravo for $2,700 here. And we get that by taking our bad debts charged, additional bad debts anticipated for a subtotal of $3,100, less the $400 for charges currently made to each year, and that gets me to a bad debt adjustment of $2,700 for 2025. Okay, and then a minus $500 for 2026, and that's shown here and here. Okay, then for number 4, we have a $600 credit here and a $600 debit here under administrative expenses. And then for 5, we have the $6,000 debit to accounts payable and a credit to notes payable. Pretty easy one there. And then number 6, we had a $6,000 debit to accumulated depreciation equipment. We had a credit of $10,000 to property, plant, and equipment, both to take those items off the register. And then finally, a $4,000 debit to retained earnings to correct for that prior period. And here are those adjustments. Proceeds from the sale, $7,000. $4,000 book value gives me a gain on the sale of $3,000, less the income credited, $7,000. So that gives me a $4,000 negative to retained earnings. Okay, a litany of errors there, as you can see. Okay, so if we put this into practice further, the Clark industry is in the process of closing its books for 2026, and they discovered the following errors. One, on December 31, 2025, Clark received $50,000 as a prepayment for renting office space for the following year. At the time of the receipt of the rent payment, the company recorded a debit to cash and a credit to rent revenue. It made no adjusting entry as of December 31, 2025. Okay, number two, Clark's accountant recorded a purchase of merchandise for $9,000 in 2025. That applied to 2026. The physical ending inventory for 2025 was correctly stated. The company uses periodic inventory method. Okay. And then number three, at the beginning of 2024, the company purchased a machine for $5,000 with a salvage value of $50,000 and a useful life of 5 years. The bookkeeper used straight line depreciation, but failed to deduct the salvage value in computing the depreciation base for the 3 years. So they want you to alpha, determine if the error is counterbalancing or non-counterbalancing, and bravo, prepare the correcting entry if necessary. So if we look at number one here, that was where we received the prepayment. That is a counterbalancing error because on December 31, 2025, the prepayment should have been recorded as unearned rent revenue, not revenue, as pretty obvious. The rent revenue, net income, retained earnings are all overstated for $50,000, and the entry on December 31, 2026 to correct the opening balance of retained earnings and properly record rent revenue for 2026 is as follows. So we debit to reduce retained earnings by $50,000 and credit $50,000 of rent revenue. For number two, this is a counterbalancing too. That's where the purchases for 2025 are overstated. I'll go back just to show you number two here, where we purchased merchandise for $9,000. And net income and retained earnings for 2025 are understated by $9,000. The entry on December 31, 2026 to correct the opening balance of retained earnings and properly record purchases in 2026. Notice we're using the account purchases here because this is a periodic inventory. So this is not to inventory. So we debit purchases for $9,000 and credit retained earnings for $9,000. Then for number three, this is not a counterbalancing error. Let's go back. This is the purchasing of the machine with a salvage value of $50,000. So we have been recording $100,000 per year. That's $500,000, which should have been $450,000. And we recorded that for not 2024, 2025, and 2026. So that should have been recorded at $90,000. That would be $450,000 divided by 5 years. So if we did that, then we're going to take the depreciation that we did take, which was incorrectly taken at $200,000 for 2024 and 25, and $100,000 for 2026, it should have been $180,000 for 2024 and 2025. That would be $90,000 per year times 2, and $90,000 here in 2026. So the difference then to correct is going to be $20,000 for 2024 and 2025, and $10,000 here for 2026. So the entry on December 31, 2026 to correct the opening balance of retained earnings and correct depreciation expense for 2026, we're going to debit accumulated depreciation to reduce it by $30,000. We'll credit depreciation expense for $10,000, and the remaining $20,000 will credit to retained earnings. Okay, now we're going to look at making computation and preparing entries necessary to record a change from or to the equity method of accounting. So if we're changing from the equity method to the fair value method, we have several things to consider here. One, earnings or losses previously recognized under the equity method should remain as part of the carrying amount of the investment. Number two, the cost basis is the carrying amount of the investment at the date of the change. Number three, the investor applies the new method in its entirety. And number four, at the next reporting date, the investor should record the unrealized holding gain or loss to recognize the difference between the carrying amount and the fair value. So, if we have dividends in excess of earnings, a very rare situation, but happens, those which should be accounted for as dividends as a reduction of the investment carrying amount rather than as revenue. The reason? Dividends in excess of earnings are viewed as a liquidating dividend, with this excess then accounted for as a reduction of the equity investment. This would be the situation if you happen to have a one-time investment, say for you're going to be in the gold mining business, and you buy a plot of land and you've used up all that land, and you giving basically your dividends or a return of your investment at that point in time. Okay, so if we take a look at an illustration, on January 1, 2024, Investor Company purchased 250 shares of investee companies, 1 million shares of outstanding stock for $8.5 million. Investor correctly accounted for this investment using the equity method. After accounting for dividends received and investee net income in 2024, Investor reported its investment in investee company at $8,780,000 at December 31, 2024. On January 2nd, 2025, the investee company sold 1.5 million additional shares of its own common stock to the public, thereby reducing Investor Company's ownership from 25% to 10% as shown. So in illustration 21 alpha.1, that shows the net income or loss and dividends of the investee company for the years 2025 through 2027 as shown here. Okay, here's the investor's share of the investee's income, and here's the investee's dividend received by the investor. That looks like a good place to stop this video, and when we return, we'll take a look at the impact on investment carrying amount. Until that time, bye for now.